everybody. Let's get started. Today we're going to go over whether the housing market is broken or not. Is the housing market broken? What is going on? Are prices crazy? The Fed just cut rates recently. We've been reviewing mortgage rates every single week. I want to tell everybody a little bit about myself. My name is Jake Arnold. I'm a real estate investor. I've bought and sold a bunch of different properties, and I'm really trying to figure out what to do the next 6 to 12 months because I'm not sure what the market's going to look like. So, is real estate broken? As you can see below or over here, I have Osmanic AI CRM. So, AI is here. If you're cold calling, like if you're dialing and cold calling with your voice, um, AI calling is here. And check out Google Osmanic AI to be able to see what I'm talking about. But that's the system that we use for our CRM, for our customer relationship management, so that we can provide our customers with a really good experience, so that we can find deals. That's the exact software we use. So I just want to make sure that my audio is coming through. So is real estate broken? Why do I say that? The reason I say is real estate broken is because I feel like prices are crazy. I feel like everybody wants an arm and a leg for their house. Sellers think their house is dipped in gold. You have an 1890s house and you want $400,000 for it, even though the roof is caving in. So I think real estate might be broken a little bit. Today we're going to talk about why. So we've been tracking mortgage rates basically every single week. The Fed dropped rates, their Fed basis rate on the 17th or the 18th, they announced it. Jerome Powell came out and said, we're cutting by 50 basis points. But what does that mean? That means that they're dropping the Fed's funds rate. So the Fed fund rate is basically your overnight lending interest rate that you lend to banks, because banks, before they go to bed at night, they need to have a certain amount of money in the vaults to meet their reserve requirements. So if they don't have enough money, they have to get it from the Federal Reserve, and they pay interest on that money. And the Fed funds rate is the interest that they pay on that money. That's what sets that level. So when the Fed funds rate falls, that means that banks now don't have to spend as much money in overnight lending costs. And typically, those savings get passed on to consumer. However, during this cut, we actually saw mortgage rates go up a little bit. So mortgage rates went up after the Fed cut, but this is accurate data for today. And since last week, it has come down about 0.1%. Now, the short term has actually went up. So there's been less appetite to lend short term, which means that investors think short term, maybe the economy won't be as good, but longer term rates are coming down. And this is from last week and the week before that. So every single week we've been going over mortgage rates and why they're changing and what's happening with them. So as you can see, it's September 12th, 2024. This is from Freddie Mac. So this is Freddie Mac's survey from all the banks that it works with. Freddie Mac is a government entity. It was bailed out in '08. And they basically buy all of your conventional mortgages, right? Fannie Mae and Freddie Mac buy up to 70% of the conventional mortgage market. And so we track from Freddie Mac their surveys of all the banks that they work with to kind of see, what rates they're giving out on average. So I've been checking this site for these presentations. And as you can see, for September 12th, 2024, we had 6.2% 30-year fixed rate mortgage. And on the 15-year fixed rate mortgage, we had a 5.27%. And then once the Fed dropped rates, the 18th, they announced rate drops, right? We went down a whole point or 11% or 0.11%. And our 15-year went down 0.12%. But since then, let's just go back one slide. We really haven't had a lot of change. So our 15-year actually went up a little bit, and our 30-year is still coming down. So rates are still coming down. I'm pretty sure a lot of people expect the Fed to cut rates again in October. Um, or no, I think the next meeting is November, right after the election. So November 5th is the election. And then you have the Fed meeting right around that same time. And a lot of people are expecting a Fed cut in November. So one of the reasons I want to make this is because prices are just so high. Like it's kind of crazy. Like I'm out doing real estate every single day. This year we flipped over 40 houses this year. We're currently under contract to sell a 20 unit building. I am house hacking the 20 unit building right now. I'm living in a 20 unit building that we bought years ago, and we're finally under contract to sell it. But so we've done a lot of deals, and I'm not going to say that I'm like a real estate mogul by any means, but in our local market, we have a pretty good gauge of what's going on because we're so active. So in Northeast PA, we've done a lot of deals. We basically look at everything that comes through that area. So we have a really good idea. And we're even starting to see prices in Northeast Pennsylvania get out of control. So this was on the Federal Reserve's website. This is from the census, the Housing and Urban Development Department. And, since 2022, basically average sale price of houses were over $500,000. So your average home price now is over $500,000. Over $500,000 is your average home price. Back in 2020, it was, it's been rising rapidly. Ever since they printed all that money, home prices have been going through the roof. So we're at an average sale price of over $500,000, and this is directly from the Fed. As you can see here, back in 1980, we were around $100,000. Back in 1990, we were around 150. Back in 2000, we were around $2,000 or 200,000. And then 2000, running up to 2008, we shot all the way up to $300,000 for your average sale price. And then coming off of '08, we had a major dip down to, 275,000 median sale price. Now, coming out of '08, we're way back up over $500,000. That's so crazy. That's a lot of money. So we've basically doubled your average sale price for a residential home in the United States of America in the last 16 years. So it's very interesting. So why are prices going up so much? And even though the Fed cut rates recently, and even though the Fed raised rates so much and did all of the quantitative tightening measures, real estate has still been going up in price. Why is that? Is real estate broken? So we have an average sale price in the United States of over $500,000 currently, and that's extremely high. I think in Canada it's around 900,000. One of the reasons is the cost to build. So since COVID, prices went crazy, right? But they're still going kind of crazy. In Northeast Pennsylvania, we've seen a lot of appreciation. We've seen because we're an affordable market, it's still like it hasn't come down at all. There's a lot of really high pricing going on in our market, and these are 100-year-old homes, right? So the cost to build has gotten incredibly high. As you can see here, this is a chart of lumber. So you can see back in 1980, 1,000 board feet of lumber used to run you about 211. And you can see during COVID that it basically got to like unprecedented levels, right? And that completely messed up the supply chain and completely messed up building prices. And we're still feeling those effects. But now we've leveled out back to a reasonable range, back to where we were, before COVID. But this is one of the reasons is the price of lumber, the price of labor, the price of everything has gone up, right? But honestly, it's not the biggest reason. The biggest reason that you are struggling with affordability issues is because of your government, because about 40% of the cost to build a new home is tied up in regulatory compliance. So, to get a house built, you need to pull permits, you need to do the site work, you need to get the entitlements, you need to work with the city, and you need to follow those directions. And, and about 40% of the housing cost is wrapped up in regulatory compliance. So not only has lumber went up, not only has labor went up, not only has, the wiring went up and basically everything, but also the regulatory compliance that you have to meet has gotten more stringent. So 40% of a new home goes to regulatory compliance. And that comes from the National Association of Home Builders. So as you can see in this chart, the cost of compliance is at 40% right now. So regulation and land restrictions are just killing the housing market because it's so hard to build new housing. It's even hard to renovate existing housing. But as you can see, the demand is here. There's so much demand for single family homes, new single family homes in particular. And so one of the reasons that Northeast Pennsylvania is going up in value so much is because of this chart right here. That's because there is way more demand for houses under $300,000 than are currently being built. So the blue chart is the price of single family homes started, like this is actually being built. And the red chart is the price buyers expect to pay. So a lot more buyers expect to pay, they want to pay around $150,000 to $250,000. But only 5% of the homes being built match that price range. That's a very difficult price range to get. If we step it down one more time, 11% of buyers expect to buy a house between $100,000 and $150,000. Nobody is building a house for that cost. Zero. So we do have 5% of builds between 150 and 250,000. And then we even out around the 250 to 350,000 mark. So the prices in my local market are starting to approach the $200,000, $250,000 mark. And that's when it makes sense to build, right? When you start approaching these price levels, it makes way more sense to build new construction than renovate a 1900s home and put it on the market because it's 100 years old. Why are you paying the same amount as you would for a new build? So that's where we're getting to in Northeast Pennsylvania, but we've been there for a long time all over the rest of the country. Unfortunately, though, it's very hard to build and it's very expensive to build, especially when the cost of compliance is at 40%. So depending on where you're building, those compliance costs might be lower or a little bit higher. Like in California, it is very, very, very difficult to build. And the average cost of regulation in the price of a new home. So if we look at our 2011 survey, it was about $65,224 that went to satisfying regulation. So, pulling the permits, getting the building inspected, working with code enforcement, zoning enforcement to take care of all the things that were needed. It was $65,000 approximately in 2011. 2016, we see 84,671. And in 2020, we're all the way up to $93,000 for regulatory compliance. That's how much it costs to comply with the government when you're building a new home on average. So this is one of the reasons that the housing is getting so expensive, right? Because we have a limited supply. People have not been building the way they're supposed to. I'm going to show you a little bit. This was a really good article. So I kind of want to go over this article real fast. So a new National Association of Home Builders study shows that on average, regulation imposed by governments at all levels account for $93,870 of the final price of a new single family home built for sale. Of the 93,870, 41,330 is due to a higher price for the finished lot, attributable to regulations imposed during the lot's development. So going through the entitlement process is a lot more expensive than it used to be. It's a lot harder than it used to be. The remaining 52,540 is a result of regulatory costs imposed on the builder during construction after the builder purchased the finished lot. So this is permits, building inspections, things like that. So you have about $6,473 on average in applying for zoning approvals. Then you have about $11,791 in hard cost of compliance, so fees required for the engineering studies, things like that. And then land dedicated to the government left unbuilt, so like green zones, because when you're doing a large development, they typically want to see green zones and things. We're at $10,854. And then our setbacks, making sure we meet our standards and things that go beyond ordinary, we're at $8,992. OSHA, other labor requirements, 1,070.79. Pure cost of delay during development, 1,442. Fees paid by the builder after purchasing the lot, 12,184. Changes to building codes over the past 10 years, $24,144. So that's like the building code changes in the midst of the project, right? Architectural design standards beyond the ordinary, that's $10,794. Pure cost of delay during construction, $941. OSHA, other labor compliance during construction, $4,477. So I would say that delay is probably a lot higher than what is being accounted for in here, because delay, from my experience, is the biggest part. Is you try to get a permit and it takes forever to get a permit, and then you're just sitting there paying people to do nothing because there's no permit. So the individual line items in the table range from 1,000 per home for the pure cost delay during the construction phase of the project to more than 24,000 for changes in building codes over the last 10 years. So that's like a good study that the National Association of Home Builders has put out to justify some of their costs. And let's go over a real quick history of what these regulations looked like. So I'm just going to go through really, really fast so it's all documented. So I truly believe that one of the reasons that we're struggling with an affordability issue is because of land restrictions and government regulation. So if we look back into the 1960s and 1970s, regulatory costs were relatively low compared to today. Building codes were less stringent, and there were fewer environment and safety regulations. Zoning laws started gaining importance, but compliance costs were still a minor portion of overall construction expenses. And then we have the 1980s, 1990s. During the 1980s and 1990s, regulatory environments began tightening, particularly with the introduction of more stringent environmental regulations, such as the Clean Water Act. Zoning restrictions became more common, and urban areas began implementing growth boundaries, which increased the cost of land and development. By the 1990s, regulatory compliance became a noticeable component of overall housing costs. Then we get to the 2000s. By this time, compliance costs had risen significantly. The introduction of stricter energy efficiency standards, such as LEED certification, and more complex zoning laws added to construction costs. A report by the National Association of Home Builders in the early 2000s indicated that about 25% of the final price of a home could be attributed to regulatory costs, including fees, delays, and compliance. We went over that. New slide. The cost of regulatory compliance continued to rise, so we're in the 2010s now. The cost of regulatory compliance continued to rise, driven by local and federal regulations regarding energy efficiency, environmental protection, and labor. By 2016, the National Association of Home Builders reported that regulatory costs accounted for over 30% of the price of a newly constructed home. Factors such as stormwater management, environmental impact studies, and affordable housing mandates also added to the burden on builders. And now we get to the 2020s today. In the 2020s, compliance costs surged further due to increased environmental standards. labor regulations, and supply chain disruptions, exacerbated by the COVID-19 pandemic. Rising material costs, along with more expensive energy and safety standards, such as updated building codes for resilience against natural disasters, contributed to higher costs. By 2022, regulatory compliance could account for about 40% of the cost of a new home in certain markets, according to the National Association of Home Builders studies. So we're currently at 40% of the home price goes to compliance. And then the supply issue. So this is I'm going to share my screen here, and this is the issue that we're currently experiencing. So this is all the new homes that have been built over time. So as you can see, starting back in, we'll start at the 80s. So during I guess we'll start at the 70s. So during the 70s, we had the inflation decade, right? We had the oil supply shocks because of the Yom Kippur War in the Middle East in 72, and then another oil embargo in 78. So there was a lot of inflation, and there was a lot of speculative building going on to prevent the devaluation of currency. So people with money were building houses, building projects to basically protect themselves against inflation during the 70s. So that's why you see this major spike here in the 70s. And then you see a massive drop off, and you see another spike again in 80 to 82. So this is when Paul Volcker came in, and he jacked rates to, I think the Fed basis rate was like over 14%. Your 30-year mortgage hit 20% during this time. But the reason so much new home construction was going on is because Reagan came in, and Reagan deregulated the credit industry, and he also deregulated like building, and he also created massive tax incentives. So that's how they tackled this issue before to kickstart the housing when you had interest rates at 20%, was to deregulate the credit industry, deregulate zoning laws, and create massive tax incentives. So you see a huge rise in building during the 80s, the early 80s, because of these tax incentives. And a lot of the malls and things that we have today are because of the tax incentives that were put in place in the 80s. And then they were taken away in 86. So all that stuff stopped, right? And then you see into 2000s, where we basically had no building after the dot-com bust. And so in the 1990s, you had the S&L crisis. The S&L crisis was basically, you used to have S&L banks, saving and loan institutions. And all of the saving and loan institutions basically went up because there were so many foreclosures, and the government started the Resolution Trust Company to be able to liquidate those assets. Like, it was so bad, it took them 20 years to liquidate all the bad assets on these S&L balance sheets. So coming out of that is when we get into '08. So we see a massive spike in building leading up to '08, right? And it's because there was demand. But the biggest builders in '08 went bankrupt. So basically, like, I mean, my stepfather, a lot of people went bankrupt in '08, and they lost everything. My stepfather had a 60-person crew. He was building Hilton hotels all over the country, um, doing millions and millions and millions of dollars. And the developers went bankrupt on him. So when a developer goes bankrupt, they just don't pay their contractors, right? So what happened is all the builders lost everything, or they stopped building, and you haven't had a lot of building activity going on from 2008 until about 2020, and after COVID, when rates were, virtually 0%. So you have this massive period, you have this long period of no new construction because it didn't make sense to do it. And we have a huge supply issue because of it. So this is total listings from Realtor. This is the total listings from 2017 to 2024. So I also wanted to look at like, okay, so prices are over $500,000. Average sale price in the United States is over $500,000. Is this going to continue? Should I put all my money into new development? What should I do? So the reason I'm doing this research is to kind of help myself learn, as well as maybe educate some other people. So if we look at the total listings, and we do this every Thursday, 6:30, we'll be going over the market, we'll be going over real estate, we'll be going over deals, we'll be going over everything. We looked at the mortgage rates the last month because the Fed was expected to drop rates, um, and everything happened as expected. So if we look at the total listing count, according to Realtor, I also thought it was really interesting when looking at this, is like the most listings hit the market in the summer, which everybody knows that, right? Like summer is hot season, winter is dead. So your days on market goes up like crazy in the winter. Summer is when everybody's trying to move. And this reflects that as well. So 2017, you had a bunch of listings. You had pretty, you had regular inventory. That's the thing, like 2017, 2018, 2019, like that's like normal, I'd say. Or that was like it was a tough market, but it was kind of normal. So this is the amount of listings and inventory you have on market during regular times. And then if we look at 2020, the amount of inventory drops dramatically. It's on the same trajectory as 2017, 2018, 2019. And then March, once people realized that COVID isn't like what everybody thought it was, and rates were at 0%, people started buying. And so you see inventory drop from then on. And then 2021, inventory remains super low. 2022, inventory remains super low. 2023, inventory remains super, super, super low. So now we get to 2024. Inventory is starting to get to our 2020 levels again. So inventory, as of August, inventory is still low, but it is starting to pick up. And with some of the rate drops that we've had, the reason that people aren't moving is because they have low fixed rates, right? And people don't want to give up that rate. So once they get close enough, people are just waiting to move. Like there's a lot of people that want to move right now, but they're just waiting. So once rates get a little bit where they make a little bit more sense, you know that people are going to be selling, right? So I would suspect that this inventory number, I, we should get back to 2017 levels. Like I don't understand why we wouldn't. But inventory so far has not gotten to those heights, and we're above 2021, 2022, 2023, but we're still under 2020 level supply. So I actually want to go over this article a little bit deeper because they just came out with this September 5th. So August 2024 monthly housing market trends. The number of homes actively for sale continues to be elevated compared with last year, growing by 35.8%, a 10th straight month of growth. It now sits at the highest since May 2020. So our inventory levels are currently the highest they've ever been since May 2020. The total number of unsold homes, including homes that are under contract, increased by 20.9% compared with last year. Home sellers slowed down their listing activity in August, with minus 0.9% fewer homes newly listed on the market compared with last year. This is the first negative reading in nearly a year. The median price of homes for sale this August decreased by 1.3% compared with last year at $429,909. However, the median price per square foot grew by 2.3%, indicating that the inventory of smaller, more affordable homes continues to grow in share. So, small, affordable homes are hitting the market. Homes spent 53 days on the market, the slowest August in 5 years. This is 7 days more than last year and 3 days more than last month. The share of listings with price cuts reached the highest for an August in over 5 years, increasing by 3.1 percentage points compared with the last year to 19.3%. So 19.3% of listings had price cuts, We estimate the current relationship between rising inventory and days on the market to be about 6 to 1. For US metros, every 6 percentage point annual increase in inventory is correlated with a 1 day increase in the median days on market. So this is saying that for every 6% that your inventory goes up, you're going to spend another day on market, is what they found. And this is a year over year inventory change. So, in days on market, what's more, we find decelerating market speed is highly correlated with the rate of inventory accumulation. More specifically, across the 50 largest US housing markets, we find that a market slows by about 1 day for every 5.5 percentage point increase in the year over year number of active listings on the market. In a more stable inventory environment, this may not amount to much change in the market. However, in today's rapidly growing inventory market, that amounts to change in some markets of up to 15 to 20 more days compared with last year. The number of homes for sale continues to accumulate, but is still not back to pre pandemic norms. There were 35% more homes actively for sale on a typical day in August compared with the same time in 2023, marking the 10th consecutive month of annual inventory growth and the highest count post pandemic. This is a deceleration from July, which was up 36.6% year over year. This is the second consecutive month where the rate of growth has decreased from the prior month. While inventory this August certainly continues to improve, it is still down 26.4% compared with typical 2017 to 2019 levels. This is a slight improvement from last month's 26.8% gap. And this is the chart that we looked at before, where we saw that active listings are still, you know, oh no, I guess they're starting to go above 2020 levels. Okay, so the last chart we had was different. So I guess we have exceeded 2020 levels for active listings. I guess the last chart was our inventory. Yeah, this is total listings. Okay, so total listings, we're still not at the point we were in 2020. But active listings, we've gone above our 2020 levels. So we're starting to get back to a normal market. And I definitely feel it. The number of homes under contract but not yet sold, pending listings, increased by 0.3% compared with last year, which is less than last month's 1.8% gain. As mortgage rates fell in August to their lowest in 18 months on lower than expected job growth in July, and expectations that the Federal Reserve will cut rates 3 times this year. It's likely that some potential buyers are sidelining themselves until rates come down further. It is also important to note that back in April, we predicted that the growth in pending listings would slow, and this materialized in May, June, July, and August. We think this could be the trend up to the Fed meeting in December. So they're expecting that you continue to see inventory hit the market and your growth in pending listings slows all the way up to December as the Fed continues to cut rates. This is the pending listing count. And we're on normal trajectories as 2018, 2017, 2019. As you can see, 2021, 2020, and 2022 were much higher. We're back to normal in regards to pending listings. So just like buyers, sellers pulled back this August as newly listed homes were 0.9% below last year's level in reversal from July's 8.4% gain. This breaks a 9-month streak of increasing listing activity. We think the sharp decrease in mortgage rates seen in mid-August could lead to an increase in listings in the coming months as lower rates begin to entice the marginal homeowner to sell. However, we don't expect selling activity to rise in any significant way until next spring, when rates are likely to be much lower and the typical seasonal rise in inventory is upon us. So they're expecting spring to have a lot of inventory on the market as rates are now lower, um, and people that want to sell or need to sell, this is their chance to sell and buy something else, or whatever. Um, but when rates are lower, there's definitely more activity. So they're assuming that spring will be our peak in listing. So as you can see with the newly listing homes, people are definitely holding back on listings as we are below our August averages for the last 5 years. People are not listing their home because of the things that I mentioned before. They're locked in with low rates, and it doesn't make sense to go out and buy something new. And the affordability problem, too, because they can't find anything that makes sense according to what they already have, right? So, regional and metro area inventory trends. So, real estate is not macro, it's super local. The South and West are closest to bridging the inventory gap. In August, all four regions continue to see active inventory grow over the previous year. The South saw listings grow by 45.6%, while inventory grew by 34.5% in the West, 23.1% in the Midwest, and 13.9% in the Northeast, compared with the typical August from 2017 to 2019 before COVID pandemic. South saw the smallest gap in inventory, down 11.7% compared with pre-pandemic levels, while the gap was 15.9% in the West, much larger than the Midwest and Northeast. So there's lower inventory in the Northeast than there has been typically because of that affordability issue that I was showing you before. The inventory of homes, because now homes in the Northeast are so high, right? So people aren't listing it because like they bought their house for $50,000 and now everything's $200,000. The inventory of homes for sale increased in all 50 of the largest metros with last year, compared with last year. Metros that saw the most inventory growth included Tampa, San Diego, and Orlando. So I was living in Tampa area for a little while, so I'm pretty familiar with that area. And my conclusion after living in Tampa or St. Petersburg, trying to build there, trying to flip there, was that it was a complete bubble. So, despite higher inventory growth compared with last year, most metros still had a lower level of inventory when compared with pre-pandemic years. Among the 50 largest metro areas, 11 saw higher levels of inventory in August compared with typical 2017 and 2019 levels. This is up from 10 metros last month. The top metros that saw inventory surpass pre-pandemic levels were predominantly in the South and West and included Austin. So the South is where inventory is really hitting the market like crazy because that's also where you've seen, a lot of people move to. The Northeast is a lot more insulated. It's still very affordable, but it's getting to the point where it's not. So days on market, time on market was 7 days more than last August. So houses are sitting on the market longer than they were in 2020, than they were in 2021, than they were in 2022, than they were in 2023. We're still not at the point of 2017, 2018, 2019, but we're close. We're close. So the average days on market is 53 days right now. And this time last 2017, it was 60 days. I just want to scan through this article a little bit more. Oh, these are the price reductions. So this is the price reductions that we've had in previous years. So 2017, uh, like we're having a lot of price reductions because basically people, think their house is dipped in gold because Johnny's house next door is listed for $350,000. Even though I bought mine for 40,000, I should list it for the same as Johnny's next door, 350. But it's not selling, right? Because nobody can afford that in this area because the local wages don't support that. So they're doing price cuts, and that's what I'm seeing in my local market. Because we're starting to get to the point where an 1890s house is $400,000, which does not make any sense. So yeah. Oh, this is good. So this is the regional statistics. So this is what I'm seeing on the ground as well. So the Northeast active listing count versus pre-pandemic. So we have 54% less active listing in the northeast of the country. So I'm in Pennsylvania, which is northeast, and new listings are the same. The median list price is about 46% higher year over year, which is the highest out of all these other categories. Median price per square foot is also higher than any other categories. So the Northeast right now is seeing the most appreciation. They're seeing the least amount of inventory. And the South is seeing the most uh, new inventory and things like that. Now, if we look at year over year, the Midwest is about 23.1% higher year over year. The Northeast, 13.9%, the South, 45.6%, and the West, 35.4%. So we're about 1.5% down. South is 5.2% up. The listing price is 4.3% up, and the South is 1.5% down. And right here is a list of median home price, median listing price year over year change, median listing price per square foot change, median listing price versus 2019. So in Atlanta, we're at 29% higher prices than we were pre-pandemic. Let's see if we can find Pennsylvania. Oh, this is only so Detroit, Michigan, we're only 10% higher. Pittsburgh, we're 22% higher than we were pre-pandemic with the median sale price of 245,000. Tampa, St. Petersburg, we're 47% higher than we were pre-pandemic with the median home price of 415,000, which that's one of the highest on this list. And your price per square foot is just out of control. New York, that's not a good accurate. I want to see if I can find more Pennsylvania. Let me see if I can. Oh crap! I don't know. Does anyone see any PA on here? Drop a comment if you guys have any questions because I am going to be moving on to my last couple slides here. If you have any questions, please drop it in the chat below. I will definitely get to them. So yeah, that's basically. I wanted to go over that report from Realtor, how our inventory levels are starting to get back to 2020 levels, but we're still not at pre-pandemic levels in regards to inventory and total listings on MLS or on Realtor. So I also wanted to point out another reason, like why are the prices going crazy? And I know there's been some talk about the government coming in and building a couple million housing units or something like that, but typically whenever the government builds something, so I wouldn't rely on the government to reduce your housing prices. Basically, every time that the government builds something, it's 15 to 25% higher than the private market doing it. So if the government builds your housing, like some people are talking about, maybe 2 million units, it's probably not going to be less expensive than if the private market did it because historically that's never happened, right? And can the government even complete a housing project? Are they competent enough to do that? And if they increase supply, will it actually bring prices down? Because that's kind of what they're saying the solution to the issue is the government needs to come in and build housing. But I think the solution to the issue is that the government needs to deregulate housing, make it easier to build. Instead of the government doing it for super high cost, the private market obviously does it better. And we're going to look at this. Oh, crap. Real quick. I wanted to go over this last article just to show how much more it costs for the government to do something than the private market. So, how construction costs are increasing the federal facilities backlog. With over 130,000 properties in its portfolio, the federal government is the single largest owner of real properties in North America. So the United States government owns more real estate than anybody. Okay. But the maintenance needs for those properties are continually outgrowing the work being done to address those needs each year, despite the GSA, the agency that acts as the federal government's property manager, requesting budgetary provisions for $1.3 billion worth of repair and modernization projects in fiscal year 2021. So the government typically does things a little bit more inefficient. So durable materials, background checks. I think this is a pro-government article I'm reading too, which is funny. Or no. So 35%. Yeah, I think this is a pro-government article. But even this, shows how much more expensive it is to do federal construction work than it is to do private construction work. There was just a recent project going on in California where it cost, I don't know, a few $1 billion per mile to get a rail trail done in California. And China is doing it for like $21 million a mile. This is the last thing I wanted to touch on is new residential sales, August 2024. So there were 716,000 new houses sold in 2024. New houses for sale, 467,000, and the median sale price was 420K. Let me zoom into this article more. So this is over the last 5 years of houses sold. So there's most houses sold in 2020, and then we've leveled out and consolidated pattern. But the number of listings is rising rapidly. The amount of homes sold is staying about the same, but the number of listings is rising rapidly. So sales of new single-family homes in August 2024 were at a seasonally adjusted annual rate of 716,000, according to estimates released jointly today by the U.S. Census Bureau and the Department of Housing and Urban Development. This is 4.7% below the revised July rate of 751,000, but is 9.8% above the August 2023 estimate of 652,000. The median sale price of new house sold in August 2024 was $420,600. The average sale price was $492,000. So at the beginning of this presentation, I showed how the average sale price is around $500,000, $500,000 for a new home, which is just extraordinary. So it brings me back to this question: is real estate broken? If anybody wants to comment or if anybody has any questions, please drop them below. So, I mean, if we pull up Zillow, you can see a lot of the data that I'm talking about in action. Like how many of the properties in my local market are getting price cuts right now. This is what's crazy. So this is Northeast. Let me share this tab. Let's look at Zillow for a second. Oop. So 405,000, 290,000, 159,000 for a lot, $495,000 for a lot, 1.25 million for a house, $175,000 for a lot, $273,000 for a house in Dallas, $350,000 for a house in Shavertown, right? Zoom into Wyoming. $450,000 for a house in Wyoming, Pennsylvania. $239,000 for this house. $190,000. This is a freaking studio. $75,000 for a vacant lot in Wyoming, Pennsylvania. That is wild, guys. This is crazy. The reason that these prices went up is because people are seeking out affordability, right? As we saw beginning chart, people want to pay. This is what people expect to pay versus what people are actually building. So about 8% of buyers expect to pay less than $100,000 for a home. 11% expect to pay 100,000 to 150,000. But in both of those categories, no new homes are being built. And then we get to the 150 to $250,000 range. 19% of the buyers expect to be in that range, with a 5% of homes actually being built that way. So our existing supply of homes that meet that criteria are getting gobbled up because you have all this demand for buyers, right? But once we cross that threshold, I'm pretty confident that it's going to dry up, right? I think the max for an affordable area for a 1900s or an 1800s home is $250,000, and then you have to start building new. So we're reaching those levels in Northeast Pennsylvania, and I just think it's wild. Like, $179,000 for this 2100. Like, these houses are built on top of a coal mine, and they're also 100 years old, right? $329,000 for a house in Duryea. That is just, incredible. And you are seeing price cuts, right? You see a lot of different price cuts. But also, realtors are still telling their clients that, like, yeah, you should list it for like what Johnny did down the street. Price cut 25,000, August 31st. No price cut there yet. Can you filter price cuts on Zillow? There's price cut 21,000. Yeah, these prices are very, very high. Very, very high. $5,000 price cut. So this is what I mean. People are like, "Oh, you're not paying like you're not acting like the house is dipped in gold." Jake, you're bad because you're not overpaying for a 1900s house. You're not giving them $400,000 for a house that was built in 1890. You're bad. But in my opinion, the house is not worth $400,000. I don't think it is. I think we're in Looney Tune times. So the most I would pay for something that needs to be fixed up in this area is about $50 a square foot. So if we look at, what some of these are much higher than $50 a square foot. Like, this is incredible. So, I might be stepping out of the market for a little while here, guys, because there's no way I'm paying this for a 1900s house. But if we go down to Florida, where the market has the highest inventory and is experiencing the most sales. So this is where I was living in St. Pete, very desirable area. Okay, so we just saw 400,000, 300,000 in Pennsylvania, right? Wyoming, Pennsylvania, $100,000 for a vacant lot on top of a coal mine. Okay, let's look at a place where actually people want to live. So 470K for a really nice house on a lake, and that has a price cut. 430K, 385K. These aren't the greatest house. 295K for Kenneth City, Florida. 230K, 329K, 300K. This is an expensive part of Florida too. This is St. Petersburg. If we go over to Orlando, but I do want to stress the point that the reason for expense is because if you can't build, there's not going to be more supply. So 325K for a house in Florida, Orlando, 340K here, 550K, that one, 365K, Kissimmee, Florida, 340K, Orlando, 240K for this simple house here in Orlando, 3-bed, 2-bath, large garage, 150K for this house in Orlando, 295K for this house in Orlando, 245K for this house. Let's go back up to our market. $239K for this house. $299K for this house. Does this make sense? Thank you guys for joining me. It's going to be interesting to see what goes into the housing market. Me personally, I am still buying. I'm just only buying good deals. Um, a lot of people get mad at me because I buy good deals, and like realtors don't like that because they want to say, "Hey, Johnny, you can list your house for the same amount as Sarah down the street for $500,000. Your 1890s house, you can get $500,000 for that." Here's the thing: it's not worth it. So when I'm buying at $50 a square foot, it's because I know what I'm doing and because we're actually putting a good product back on the market where it might be worth 200, 250. But above 250 in this market, to me, doesn't really make a lot of sense. So, I think Wayne just asked, what is a good deal in this time? So, like the type of deal that I'm buying right now is so if it cash flows, so if you can buy a duplex and it cash flows today, like let's say you have a three bed, one bath on one side, you have a side by side duplex and it's currently cash flowing or it will cash flow once you increase the rent or put tenants in there or fix it up. As long as that pencils today, I think you should buy that deal and hold on to it because I think housing prices are only going to get way more expensive because the government is going to continue to print money. It's going to continue to be hard to build. It's only going to get harder. And land restrictions are going to continue to get harder. So supply will be constrained. Now, there might be an uptick in inventory because rates come down. We're in a recession. People maybe need to sell their second home. Now, people maybe need to downsize, or maybe people sell and go into a rental. Um, but you're going to see inventory spike probably in spring, and you'll see some price cuts and stuff. But I don't think you're going to see anything crazy, especially in Pennsylvania. Pennsylvania typically, like if you look at '08, Pennsylvania only went down by like 7%, whereas San Francisco went down by 45%. So Pennsylvania, you're relatively insulated, but I think, these numbers like this is wacky, right? For a three bed, two bath house. I mean, maybe not. But I think this is like 300K for an 1,800 square foot house in Old Forge. Like Old Forge is a nice neighborhood, don't get me wrong. But there's like this is 225K for a house in Nanticoke for this basic house in Nanticoke. Like this is not a good deal, right? So I would look for like I like to be around $50 a square foot. If it needs like a full rehab, if I'm doing a flip, I want to be around $50 a square foot in this market, right? Now that depends like if it's a little bit more desirable location, maybe we can work with those numbers. But I like to be selling for 125, $150 a square foot because you can build like you're getting to where you can almost build new. I think so like, the thing with old housing is so New York, they like bulldozed it all down and they built it up a bunch of times. But I don't think that's going to happen in Lancaster or Bucks County. I don't think you're going to bulldoze the whole town and then rebuild again. So I think there's going to be. I mean, I wouldn't pay $400,000 for an 1890s house. Um, you could build something new for that. So it depends. If you're at 150K on a house and you can rent it out for $1,700 or $1,900, or you think you can maybe sell it for 250 because the price per square foot is less than what you see in for sold, then I would go for that. But if you're in the 300K plus range, I would seriously consider new builds. If your price range is above $300,000, you should probably look at going with a modular company, um, or doing a stick build or doing a new build. That's kind of I'm currently looking for a primary residence, and I'm above the 300K mark, and I've been bidding on all these houses and stuff, and I have 10 houses under contract right now to flip, but they're not like, the house that I would live in. Um, so like the house that I'm not going to spend 300K on a 1900s house. I'm just not going to do it on a coal mine. I just can't do that. But that's just me though. When I was down in Florida, there were people paying $400,000 for a shack on blocks, and I don't even know if they knew that they were buying that, but people were paying it. So, like, there's a lot of hype cycles. There's a lot of like momentum that happens. I think when you have a lot of credit and a lot of debt in the market, when interest rates are really low, you have a lot of monetary, like when the federal government prints all that money, you have all this money in the system, like it has to go somewhere. And your average home price in Canada right now is $900,000. Your average price in the United States is $500,000. The average price to build is you know it's $90,000 just to comply with regulatory agencies when you're building a new house. So um, yeah, that's I. So Wayne just said old houses, but at least they're good prices. Yeah, if you can get a good deal on an old house, like that's. But I wouldn't pay a crazy price for an old house. I would look at like what can I build new and what can I buy pre-existing, maybe fix it up a little bit. But if you're close between buying something, uh, that's 1950s, 1920s, been renovated to what it would cost you to build something new, then you should seriously consider building something new or working with a builder. I think that's something that I'm going to start doing is building a lot because there is a major demand for new houses because this existing supply should not be getting to these levels of price. That doesn't mean that it's going to stop. I'm just saying it's kind of crazy to me. So thanks for your questions, Wayne. Is there anybody else that has any questions? Is real estate broken? Yeah, thank you guys for joining. And I do this every Thursday at 6:30 p.m. We go over the market data that I've been tracking all week. We go over my thoughts if they mean anything. Mario, why did I leave St. Pete? Because I was trying to do real estate down there. I was trying to flip or do new builds, and I felt like it was a bubble. I felt like it was like way overpriced. I felt like a lot of people were moving there, and they didn't really. I think what happens is when people are buying a home down south, it's like So if you get to the point in your life where you're like, "Hey, Sally," like let's say you're a husband and wife, you have 3 kids and you're doing well in life. Now it's time to get a vacation home in Florida, or maybe you want to move to Florida for the climate or something. You're going to work every day still in the Northeast, right? So you're looking at houses down south. You're not really checking it out like that. So I think a lot of people are buying stuff that are like duds down south and they don't even know what they're buying, but they're still paying crazy prices because they're selling their home in California, they're selling their home in New York, they're selling their home in New Jersey, and they're buying stuff down in St. Pete and it's jacking the price like crazy. So you have like all this regulation, you have major property taxes in New Jersey, New York, and the home prices are just extraordinary. So people are selling their houses there, moving down to St. Pete, and then paying an arm and a leg for a shit box, to be frank. So that's what I saw, and I didn't want to compete with that. I saw a lot of appreciation happening up in Northeast, and I think the Northeast has a lot of good things going for it in regards to like the climate with AI, data centers, the energy, the land. And even though I complain about regulations and building regulations, staying compliant in regards to housing, I think Pennsylvania is pretty good on those notes. Sandra just said, "Is it worth going to courthouse websites and researching sheriff tax sales?" Yes, absolutely. So, um, my business model, I try to get a hold of the people before they go to the sale, right? So once you get a pre-foreclosure letter, your name is on a list somewhere and it's all public data. Once you're going into foreclosure, it's public data. So you can go out and purchase those lists and you can send those people mail, you can knock on their door, you can call them to try to save them from foreclosure, right? Because if they foreclose, their credit's going to get smoked. Uh, it's bad if they foreclose, right? So we try to get to them before they go into foreclosure, before the tax sale happens. Um, I guess your question was about tax sales, not foreclosures. But yeah, I definitely think it's worth going to tax sales. The last tax sale I went to in Luzerne County, somebody bought $1.4 million worth of properties cash. So, and I'm sure you got some good deals. The thing you do with tax sales though is you look at the list and you start identifying some of the properties that you like on that list. So they'll come out with their list and they'll publish it on the website for whatever county you're in. Or you can go to the courthouse and get it. And you'll want to look through that list and try to identify properties that you think would be good. And then like you should go there, and I'm not saying this, but you should, you know, you should try to figure out if it's a good deal. And then some people even do title searches on the ones that they think they're going to bid on. So you can do a title search on you can be like, "Hey, title company, this is the foreclosure list that I want to, or this is the sheriff sale list that I want to go after. These 10 properties. Can you do title searches on all these?" So you might have $5,000 in sunk title costs looking for, issues with title, but all the other people at the sheriff sale, like a lot of them are not doing that. So if you have the title search, you're going to be super confident that it's a good buy. And if you went there and checked it out, you're going to be pretty confident. Mario said, I agree, but there are a lot of pockets down here with decent margins. It's different from PA in the way the area is laid out. I'm in agreement that by far PA is better depreciation, but Florida is a better lifestyle. I think, the, I think where I was in St. Pete, I was in St. Pete. So St. Pete was like going crazy. St. Pete is like one of the places that everyone's moving to right now, or was when I was there. So, I think that's true. We looked at some houses in Orlando, and there's houses in Orlando that are really affordable. Some people say like Orlando is being overbuilt and stuff, but you know, how do you find the list for the foreclosures? So you can go on PropStream, and so PropStream.com. You can select the filter pre-foreclosures. You can also find other data sources. You can go to banks and you can work with the REO people at the banks. There's some agents that only do foreclosures. So you could work with those agents. Typically those agents like don't answer the phone or anything. They're really hard to work with, but they come out only when foreclosures are out. And so I've just started seeing them because delinquencies are starting to pick up and stuff. But uh, I would start at PropStream, see if you find any there, and then just scour the internet, work with REOs at local banks, things like that. Does the asking price include liens, etc.? So the amount you pay is free and clear. So when you go to a tax sale, you're buying it where you're not getting a title search on it. You're not, um, like you're just buying. There might be a $500,000 IRS lien attached to it after you close, and like none of those are being cleared. You're just buying it. They're quit claiming the deed. You're taking it with all the encumbrances, all the liens on it, all that stuff. So that's like the risky part of a tax sale. So that's why like the professionals typically identify 10, 20, 5 of the properties they want to buy, and they do title searches on them beforehand. So like if I'm buying a house from you, Sandra, and you have a lien on it, you have a mortgage on it, you have unpaid taxes on it. When we go to settlement, the title company or the attorney will have a HUD or a receipt, and that'll say like this goes to seller, this goes to buyer. The seller, we have to pay taxes out of their piece, we have to pay off this mortgage out of their piece, we have to pay off this out of their piece, and all that will be satisfied out of the overall purchase price. So like if I'm buying it for $100,000 and you have $57,000 worth of liens and unpaid taxes and things like that, you'll walk away with $33,000. No, $43,000. Sorry, didn't do that math right. So that'll all be settled. There'll be no liens or encumbrances on the property anymore, and I'll have a free and clear property with title insurance, so that if anything comes up, I have a title insurance policy, and they'll take care of that. Thank you guys for joining me. I do this every Thursday at 6:30, and I hope to see you again next week. Thanks everybody that participated, Mario, Sandra, Wayne. Uh, I love when people participate. It definitely helps other people, and it gives me more things to talk about. So please join me next week, and I'll see you then. Awesome, Wayne. See you then. I'll see you next Thursday.